and welcome to our presentation. In this presentation, we will first introduce our currency pair selection, then go through the economic background of our two countries, then go through our determinants of foreign exchange, and then finally talk about our investment decision for our Forex trading session. For our foreign exchange trading session, we have selected the currency pair of AUD-USD. We have selected the one currency pair as we believe this is a lower risk situation instead of choosing two, especially when we trade in the tumultuous foreign exchange market.
And now a little background into the two economies that we have researched for speculation. The background of Australian economy. Australia has had large booming economy since the GFC. Australia has seen continual growth. As of 2017, the GDP was 1.69 trillion. It is a large exporter of natural resources, especially to China, Japan and Europe. And Australia rely heavily on natural resources to boost economic growth in the AUD.
Alright, so let's talk a little about the United States of America and a little about their economic background. They are the world's largest economy and also the most influential. This is because of how advanced their technology and infrastructure are. Their GDP is currently at around 18.6 trillion US dollars, with their major trading partners being the European Union and also China, with a mention to Australia coming in at number 24.
The first determinant we have done is commodities. When the dollar price of other countries' currencies falls, so does the dollar price of internationally traded commodities. If the currency drops, this means the same amount of commodities that can be purchased for a less amount of money, increasing purchasing power. Commodities prices are usually fixed to the USD. Commodity prices started high in January 2017 while hitting a low mid-year followed by a rise. As price levels increase, demand for dollar depreciates. Australia is to benefit from tariff exemption in trading with the USA. US prices have remained steady throughout last year. While still increasing, there could be a crash in commodity prices considering the steadiness. This could cause an appreciation of the AUD.
The next determinant we've selected for our currency speculation is inflation rate. Since 1993, Australia has seen a stable inflation rate due to an inflation rate targeting scheme. This targeting is used to help achieve economic goals such as price stability and economic growth. As you can see to the right, the inflation rate has remained stable on average at 1.6% between 2016 and 2017. Unfortunately, the March 2018 figures have yet to be released, but it is expected to remain steady in this quarter. Unlike Australia, US do not implement inflation rate targeting. Inflation rate in the US has seen an increase over the past decade, and it is expected to rise even more over the next year due to US tax cuts and increases in government spending, which encourages overall consumption, which will in turn lead to economic growth and inflation rates to increase. To the right, you can see a fluctuating inflation rate, but in March 2018, it has been recorded at 2.4%, so it is increasing. Due to different inflation rate policies, you can see a dramatic difference in fluctuations in the US and Australian inflation rates. As you can see in the red for the US, it's fluctuated dramatically, but over the past 6 months, we have seen an increase in the inflation rate of the US compared to the Australian inflation rate. With the Australian inflation rate, you can see that it is quite stable, and in March 2018, as we do not have the figures, we've gone by the December figures, and it does show a dramatic difference between the two inflation rates. How will this affect AUD to USD? As Australia has lower inflation compared to the US, we expect two things: more demand for exports, thus more demand for the AUD, and a shift to the right of the demand for AUD. We also expect less demand for imports, as it is more expensive for Australian domestic buyers to purchase imports. Thus less supply of AUD because there is less selling of AUD for foreign currency, and there'll be a shift to the left of the supply. Therefore, we believe the AUD will appreciate against the USD in regards to the inflation rate determinant. Another determinant we've selected for our speculation is interest rates. The cash rate of Australia, or nominal interest rate, has remained steady at 1.5% since August 2016. The RBA have decided to hold at this interest rate to facilitate inflation targeting policy and reducing unemployment. However, they do warn of potential increases in the cash rate in the future. However, for currency speculation for the short term, this is not something we need to worry about. The US nominal interest rate, or the federal funds rate, has seen a gradual rise over the past 2 years. In March 2018, the US Federal Reserve announced a new hike in the interest rate to 1.75%. This rate is expected to continue to rise. Through the use of the Fisher equation, we have calculated the more relevant interest rate for currency speculation, real interest rate, which is nominal interest rate minus inflation rate. As you can see in the graph here, the Australian real interest rate exceeds the US real interest rate. This is due to the US inflation rate being much higher than the Australian inflation rate, causing this difference in real interest rate. Due to the Australian real interest rate being higher than the US real interest rate, we expect more demand for AUD as there will be greater capital inflow as there will be a greater rate of return by investing in Australian businesses. This will shift the demand for AUD to the right. This will also cause less supply of AUD as higher real interest rates discourages capital outflow as it is better for a rate of return to stay in Australia. Therefore, AUD will appreciate against the USD.
Next, we'll be talking about the GDP determinant, specifically economic performance and stability, and its relationship to currency fluctuation in our currency pair. Since our currency pair is the US dollar and the Australian dollar, we'll be focusing on their respective economies. Okay, so let's talk a little about the US and its GDP growth. The US GDP growth was severely affected by the GFC in 2007, and during the 2007 to 2009 period, it was in recession and it was struggling to maintain growth. Since then, it has recovered and been able to maintain a steady, positive upwards trend up until recently. Next, we have Australia. The Australian economy was not as severely affected by the GFC as the rest of the world. This is because of the mining boom experienced and the economic reforms put in place by its politics. Australia has maintained a relatively steady rate of economic growth since then. As you can see on the graph, the Australian GDP growth averages around 4 to 6% per annum. So next we have the effects of the GDP on the Australian dollar. The Australian dollar value dipped against the US dollar at around the same time frame as the drop in Australian GDP growth. This could be explained as a drop in speculator confidence in the Australian dollar, hence the dip in Australian dollar value against the US dollar. Currently, the Australian GDP is growing at a more rapid rate than the US's GDP, and as such, we expect the Australian dollar to appreciate against the US dollar. So next, we connect GDP growth with speculation. Speculators use GDP growth and stability as a determinant of whether or not a currency will rise or fall. If they believe an economy is doing well and net exports is on the rise, they'll buy more of that currency and vice versa. Speculation from US speculators expects the Australian dollar to rise, hence it leads to investment into the Australian dollar, therefore appreciating the Australian dollar value against the US dollar.
And now for the important decision, the investment decision. All the determinants that we used to speculate the AUD to USD brought out the same conclusion that the AUD will appreciate against the USD. Our FX objectives are as follows. We will buy AUD with USD, allow the currency to appreciate, and then we'll square our position, hopefully profiting from appreciation. Thank you, and I hope you enjoyed our presentation.